What's up, everybody, and welcome to the channel. I just want to talk to you guys about some tips on how to be a better investor and how to honestly manage your entire stock portfolio for the best returns that you can possibly make. We got a lot to talk about in this video, so let's go ahead and get straight into it. But before we do that, I'll ask if you enjoy this type of content and if you like stock market investing and stocks, all that good stuff. Make sure to subscribe to the channel and turn on post notifications so you don't miss out on any future videos. But let's go ahead and get straight into it. So let's start with the beginning. How to be a better investor. First things first, don't let emotions control your decisions because, like it says, being an emotional investor really never ends well. And those who can keep their emotions out of the market perform the best. And simply what I mean by this is whenever you learn to keep emotions out of the market and you don't see your money, your portfolio amount like decreasing or increasing, any way movement can be good or bad. Like you might see a huge gain and you might just get greedy. You don't want to be greedy. And you might see a huge decrease in your portfolio and you might just be discouraged and you don't want to get discouraged. So don't let emotions be a part of the market. Next up is don't go all in on one company, because when you're investing in these companies, if you only invest in one, and let's just say, for example, that company, the stock that you bought, and it does not do well, it fails, you lose your everything. So I think that it's important to diversify and select multiple great companies to invest to. And one thing I like to stand by when it comes to investing is it's better to have a few great companies rather than a ton of good companies. Because you might have a ton of good companies, but if each company is providing you 8% returns over the year, you're still going to be having like an average 8% return. But if you have 5 holdings that are returning 20%, you're making more money than the person who just has a ton of good companies. Next up is invest at different times and not only at once. So what this means is you want to invest over time instead of just depositing one huge amount of money in at once. Now there is a lot of controversy on this topic saying, well, this period is better to just put it all in at once, and this one is better too. And what I kind of mean by this is I don't want you to put your entire life savings into the market and then not have any more money to invest after that. And so the way that I approach this pretty much is a thing called dollar cost averaging, which it means like basically investing a certain amount of money into your portfolio periodically over a long time. So for example, like maybe you're investing $500 a month over a few year period. And so that's kind of how that works. Next up is understand that you're buying a company and you're not just buying a stock. So when you look at the stock market on these numbers and guesses, if you look at it as their numbers and guesses, you're probably not going to end out getting great returns. The approach that I think is very important for people to take in the market is that you are investing in an entire company because you actually are. And whenever you take it with that approach, you usually end with greater overall returns. And lastly is don't be delusional and like be open to what others have to say, their insights and opinions on stocks that you're looking into. So what I mean by this is like it's easy to really think that you know what you're talking about, like you know more than others. You don't need to listen to anybody but yourself in the market. But one thing I do strongly believe is, let's say for example, if you're a bull in the market, you need to listen to the bear's case. What are the bears saying, So what that means, if you don't know that actually, is if you're like think a stock is going to go up, you need to listen to what the people who think the stock is going to go down, what do they think and why do they think that? And I believe it's important to hear the input, because if the market isn't seeing what you believe you're seeing, you might just be being delusional. So what that means is you might see a stock and think, oh, this stock is so undervalued. How does nobody know about it? Well, there's millions of investors, okay? There's a ton of people investing. I'm sure that other people know about it. And oftentimes these stocks are so undervalued because of a reason underlying in the company. And so there's usually a reason why. So make sure you do all your research from multiple angles and you don't just see one aspect and think the stock is a good buy. Listen to what other people have to say. And let's go ahead and talk about how to manage your stock portfolios. So first off is don't be afraid to take profits, because nobody ever went broke taking profits. Pigs get fat and hogs get slaughtered. Next up is have a price target in mind when you buy a stock that like you plan on selling. So for example, if you buy a stock at $10 and you plan on selling it at 15, sell it when it hits 15, take those profits. Next up is if a stock you buy does really well, sell some of those shares and lock in your initial investment. So for example, if you put $100 into stock and it grows to $300, what you could do is sell $100 of your investment, which is kind of like the $100 you put in initially, and then you have $200 still riding that investment, which is really good because you can lock in profits if you want, but you can't lose any money, technically speaking, once you get your $100 back. And next up is keep some cash for red days. So like any days that the market falls, I think it's important to keep cash in your portfolio to buy stocks, buy index funds, buy ETFs whenever the market is low, because you get better buying prices, which lead to better gains. And lastly is like if you made a bad investment, you made a bad investment. So I really strongly encourage that you kind of just accept it and you move on from it. Sell and take the loss. Move your money somewhere that's going to be a better use. Because if you just see a stock fall and that you bought and you're like kind of psychologically thinking like I just want it to go up to where it was, most of the time if it's falling a lot, it probably won't because there's something wrong in the company. And so it's better to just take whatever money you have left in that investment and put it in something like even the S&P 500 index ETF fund. Okay, it's better to put it in something like that and actually get returns rather than just doing nothing with that money and letting it lose value. So selling at stocks also at a loss can help you save money in your taxes, but you don't want to go selling stocks at a loss to pay less in taxes, because you only want to sell at a loss if it makes sense and your money will be of better use elsewhere. But let's go ahead, and that's the end of this video. So if you did enjoy the video, make sure to subscribe to the channel, turn on post notifications so you miss out on any future content. Thank you for making it all the way to the end of this video. I really appreciate it. Check out M1 Finance if you haven't already. It's a great brokerage. Deposit $50 and then you'll get $50 back. It's free money in there. Go check it out. Check out the link in the description or the pinned comment. Also check out my Udemy investing course. Over 7.5 hours of insanely valuable content. Check it out if you're new to investing. Even if you're an advanced investor, the content is top notch. It's on sale, so check it out while you can. And thank you, and I will see you at the next video.